Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
With hindsight, I would probably argue that we were naive. Of course, we had an idea what it means to manage capital for external investors. These investors have invested in the product based on certain information provided to them, on a relationship you have built with them prior to that. Maybe they're not caring about what you're doing there because they liked you and know you from different kinds of businesses. So this was a totally different thing, and put a lot of pressure on us on different type of situations which we did not anticipate. We haven't really covered all the aspects that would actually change once you start trading external assets.
How do you know if your trading program is set up with the right models, systems, or timeframes? How do you know if the risk parameters you chose are the best? How do you go from trading your own capital to suddenly managing external client assets? These are big questions that most, if not all, new managers have to consider and decide upon. And that's what we're talking about in today's episode of Top Traders Unplugged, where my goal is to give you the clarity, confidence, and courage you need to invest like or invest with some of the top traders in the world. It is the stories that you never get to hear, set out as the most honest and transparent account that I can make of what goes on inside the minds of some of the best investors in the world, delivered to you via a one-on-one conversation. And if this is the first episode you've heard, you may want to go back and listen to all the earlier conversations. Before we go any further, let's find out who's on today's show.
Hi, I'm Bastian Bolesta, the founder and CEO of Deepfield Capital in Switzerland, and you are listening to Top Traders Unplugged.
Thanks for doing that, Bastian. And by the way, if you want to read the full transcript of today's episode, just visit the toptradersunplugged.com website, where you can find great details about today's guest. Now let's get started with part one of my conversation. I hope you will enjoy it. Bastian, thank you so much for being with us today. I really appreciate your time.
Thank you very much for having me today, Niels.
My pleasure. Bastian, as I prepared for our conversation today, I found a couple of very different approaches, not just to trading, but also to the company's history and the way it's evolved. The big question on the trading side begin, how do we set the best team of systems and models on an ongoing basis? And the big question that you and your partners also had to deal with is the advantages or disadvantages of managing external client assets. So I think there's some great stories and topics to dive in today that I think the audience will appreciate. But before we get to your story, I wanted to ask you a slightly different question, a question that I found that many of these successful guests that I have on the podcast tend to also find a little bit challenging at times, despite it being quite a straightforward question. So it goes something like this. If someone that you don't know comes up to you in a social gathering, and, not as a business pitch or situation, and they basically ask you, Bastian, tell me what you do. How do you respond? How do you explain what you do?
I generally say that I run my own financial business together with 3 friends of mine, and that we develop algorithmic trading programs based on our own trading and market experience. Of course, it always depends on the setting, if people are more interested in finance or not. But generally, I start with the having your own business part, because that's one of the key drivers for us doing what we're doing.
Sure, great. Now, let's stay with you for a little while longer. Tell me your story, how you got into this business in the first place, and perhaps in order to put some extra color on, you can go back as far as you like, and how you were as a young man growing up, perhaps.
Nowadays, we basically run a systematic asset management company called Deep Field Capital. But how did we get here? In terms of my background, I was born in Germany and raised near Frankfurt, so naturally, an interest in finance, the financial hub of Germany, was one of the first things to think about when actually living there, because you saw the skyscrapers all the time and impressive stories of people working there. So I was quite interested in finance, but I didn't really know how to start, what kind of angle, what actually being in finance actually meant. So when I finished my A levels, I decided to study business administration with a focus on finance at Frankfurt School of Finance Management. And that particular university was strongly supported by the big financial institutions in Germany, where they had the idea that when you study there, you can work at the same time. So basically, I studied at the university, but at the same time, I started to work for Deutsche Bank as well, all in all 5 years, beginning in the late 1990s. And spent a larger part of my time in the beginning in risk controlling, particularly then on market risk controlling, which was quite exciting. I first started in Frankfurt, then I could spend some time in London as well, and later on in New York. So this was a really exciting part in terms of working. And on the academic side, I realized quite fast that whatever you're studying there does not necessarily directly connect what you have to do on the banking side. So, sure. And it was still quite interesting. The second part, I went then to China on a semester abroad, which was a very interesting time, because a totally different setting. I had to study there a little bit, parts in Mandarin as well, which I could speak slightly, but not as good. So I needed friends supporting me, translating whatever the slide said. It was a merger acquisition course, for example, and I could follow, driven by pictures, but it was really an interesting and difficult time, but a very exciting environment, I would say, in terms of the country, how fast it was developing, and what kind of opportunities were available to pretty much everybody venturing there. And then I came back, and this was kind of difficult when you come from this really fast developed environment and you come back to Frankfurt and you go back into Deutsche Bank, being German myself, so I don't want to be too hard on being German, but Deutsche Bank is a particular special financial institution, I would say, and keeps itself like that as well in comparison to the others. So this was a really difficult transition, basically, coming back from China, going back there. So I finished my degree at the university, and I actually changed the department as well. I worked then in relationship management for financial institutions in the Middle East, which was a little bit more dynamic, I would say, than the market risk controlling. But all in all, I somehow did not feel as passionate about being part of a bigger institution as I was before actually going to China. Okay. I somehow had the idea to develop my own business and make my own experience, what it means to set up a business and try things out. I'm not being part at this particular time of a large institution. So I quit in 2003 and went to China, or back to China, and tried all kinds of different businesses in this Wild West environment, I would say. It was really a Wild West environment in the early 2000s in China. I set up, together with a friend, a headhunting company to recruit talent for financial institutions. So trying to combine my understanding of the financial markets and my experience from back in Frankfurt and somehow use the environment we actually found in China to build up a business. Most of the businesses we built up throughout the years there were not as successful, but we learned a lot.
Sure.
Of some of them, we could make some money. This was quite interesting. But then probably the biggest change in terms of my future development was when I met my 2 days partners. Two of them were traveling in China in 2005 to visit a friend of mine. They knew each other from university. And so I met these two guys, and they were day traders, self-funded day traders, actually, not working for any kind of company, but actually starting really small, being probably lucky with being at the right time at the right place in the late 1990s and early 2000s. And now basically having all this experience and understanding about markets and how to make money from this day-to-day encounter with markets, sitting 24 hours, 5 days a week or something like that in front of the Bloomberg screens. And this was really exciting for me, where we thought, well, we could do something together. And the idea was to take their trading knowledge and understanding and the passion about trading and developing trading ideas and combine it with my passion for building up businesses, entrepreneurship. And that's basically when we partnered up and started Isatis, basically, which later developed into Isatis Advisory back here in Switzerland. That's probably how the entire thing started. And what could be interesting for the listeners is that, so how did we get from these prop trading into actually doing something with external investors? And this was first driven by the idea to take trading ideas and somehow offering investors a part of it, or basically an opportunity to participate in these ideas. And we first did that by developing products, particularly structured notes, for institutional investors here in Switzerland, mostly pension funds, which were running these large portfolios and were interested in getting exposure to certain trading ideas, but the entire organization structure did not really allow for reacting fast to certain market opportunities or fast rising market opportunities. So we structured products which allowed them basically to get these exposures. They then bought these products from banks who issued them, and this was a really interesting time because we could take our ideas and actually support external investors on their portfolio management with ideas we developed from our prop trading.
Do you have an example of that, Bastian? What would be an idea from that time that you thought actually this could be something an institution would be interested in?
There are probably two dimensions. One dimension is just exposure to something. So you can develop what is nowadays bread and butter business. Everybody can do it basically. You develop a basket of certain companies, let's say, for example, in the water industry, and we say water is a new big thing. Or actually, we did a lot of products on China as well. China was not as hot in the in mid 2000s. It was not at the focus of the majority of institutional investors here. So we developed a basket of single stocks or indexes on China. And this is probably the first part of such a product. And the second part is that you give it some twist, that you have mechanisms using different kind of options to lock in returns, to add a capital guarantee as well, of course, always dependent on the issuer. That's something we all learned a little bit later in 2008, that 100% capital guarantee only means something if your issuer is still around.
Sure.
And this is an easy example. So mechanisms to lock in returns, exposure to things they could not directly invest. And that's probably an easy example of what we did there.
Sure. There's two topics that I mentioned, and you've also alluded to it already, and I want to explore them a little bit further before we dive in too deep. The first thing is really that one of your partners really comes from the discretionary trading side. And I'd like you to share the story of how you went from the discretionary trading mindset to becoming essentially a systematic trader? That's not something that many people do. If you start off in one direction, you tend to sort of stay with that. Tell me about how that came about.
Very interesting question. It's probably the first starter could be that we, in the beginning, while we were actually venturing into the systematic space, we ourselves were not thinking about it like that. Let's say now we go systematic and we actually move away from our discretionary roots. We first started to develop smaller pieces of program to support our discretionary trading. And these programs were basically trading ideas put into a systematic framework and traded on an automated fashion. This was driven probably by two major factors. The first thing, if you do things like that, things become more precise. If the heat hits the market and a lot of things are going on, if you do it automatically on an automated fashion, you take away the emotional aspects of trading. There are certain trades where emotional aspects might be helpful for you, but many trades are actually much better executed if you take the ideas you had once you were not under stress and you somehow put them into a strict framework, which is then automatically executed by a program. And this was one factor why we started doing that, because it supported us on the discretionary side and made things much better in terms of execution particularly. The ideas were still the same, but execution became more precise, taking away the emotional aspect. And the second thing is you can do much more at the same time. If you, a small team, a human being in front of the Bloomberg terminal or the trade station can only follow a certain number of trading ideas. And if you start to do it in a more systematic, automated fashion, you can actually do more things at the same time. So these were probably the drivers why we started to explore that particular field. Maybe a different additional driver could be that Ralph, who was basically trading on the discretionary side, and Heiko, who was in the early days also a discretionary trader, but always very chart analysis driven, had a very interesting exchange over the years and developed the idea of working closer together. And Ralph was the guy basically first looking for the program supporting us on the discretionary side. And so we realized over the time that this is something worth spending more time on. It actually increased. It was quite beneficial in terms of making money, so it was quite profitable employing these programs. And at the same time, it was very exciting and interesting area we haven't had explored earlier. But as said in the beginning, we did not think about ourselves being discretionary traders and now turning systematic. We basically continued what we were doing the entire time. We exchanged the human being against a computer which had to follow through certain rules, which were still defined by a human being, but not when heat hits the market, but actually when you're calm and everything is well thought through.
How did Ralph and Heiko, how did they initially come up with some of these trading ideas, which you later on managed to a large extent turned fully systematic? But what was the original thinking, the original idea from trading in the way? Because it sounds to me like, although you say it was discretionary, it sounds to me that they did actually have certain rules, at least, that they were looking at or looking for. Or maybe I'm wrong here, but tell me a little bit about sort of the just before we jump into the systematic side of things, how that initial side from the trading aspect looked like.
Yeah, that's a very fair question. It's probably goes down to the terminology, what is discretionary and what is systematic. Of course, every single trader follows certain kind of rules. There are hardly any people just waking up in the morning, turning on the Bloomberg and saying, "Oh, that's a hot buy," and I don't know why, but I just think it. It's these feeling you have that you should do something. It's probably not the main driver why you're actually acting on the market. So everybody has certain kind of rules. I think the major difference between a discretionary trader and a systematic trader is that the discretionary trader can always overrule his rules.
Right.
So he actually thinks, well, that's how I want to do it. It's well thought through. And then he sits in front of the screens. There's a lot of action in the market. And I wouldn't say he gets doubts or second thoughts. It's more like, oh, no, that's not the right point. I wait a little bit. Or if, particularly on the losing side, oh, no, this will come back. You have this strong exit signal based on your rules, but you just don't follow it through. Sure. In some cases, these guts feeling make people successful. But I would probably argue in the majority of cases, it's a problem for them. So if you turn systematic, that probably means, in contrast to the discretionary part, that you have to follow through whatever you thought through in the beginning, because it's probably done by computer, or you outsource it to a different trader who's just supposed to hit the button if a light goes red or green. Sure. But the trader itself doesn't really know why it's going red and green, and he should not think about it. He should just execute whatever the signal says. And that's probably the difference between the discretionary part and the systematic part. And I would agree that, of course, the ideas which are now reflected in trading in our Singularity program, they have always been part of the thinking of the entire team, but not traded in such an automated fashion, I would say.
Sure, absolutely. Before we get to the next question, I wanted to ask you in terms of sort of the initial transition. I just want to ask you kind of a slightly personal question. You are busy building, running Deep Field Capital. What do you do when you're not busy building and running Deep Field Capital? What do you like to do when you're not in the office?
Thinking about Deep Field Capital. Family. I have a lovely family. I have 2 children. I'm 2.5 years old and 6 months. This takes the major part of my time together with my wife. And we live in Switzerland. It's such a beautiful place. I'm currently looking out of the window and see the mountains, some of them already having snow. So you can do so many things out here, going mountain biking, hiking. Prior to actually taking external investors' money, I did ice climbing as well, and things like that. Rock climbing, we still do rock climbing, but it's safe. Don't worry, investors. So there's plenty of things to do here. It's a really beautiful place to live together with a family and building up a business as well. And that's what I spend most time on.
Sure. You alluded to it just now again, and I wanted to try and get into this mindset, because this is quite a unique situation in my view. So I wanted to ask you a little bit about the debate that you had internally and everything that you really had to come to terms with in terms of pros and cons of managing external capital versus doing what you did initially, which was just to manage your own capital as prop traders, essentially. What was that thought process that you went through in order to get to the conclusion where you are now, where you actually do also run external capital?
With hindsight, I would probably argue that we were naive. It's really tough for us as a team, but we had an idea what it means to manage capital for external investors. We had built these relationships with institutional investors here in Switzerland, and I had my experience with institutional investors in the Middle East when still working for Deutsche Bank. So we knew what it actually means to deal with investors, but the large difference to our experiences in the past and what basically happened once we actually accepted external assets for trading in the Singularity program is that now you're actually actively managing money. The structured products we developed, these were one-time products. They were not actively managed. you did something good or you didn't something good, but you couldn't do anything about it. The only thing, the investor could sell it with a loss, or he was really happy because it was a successful trading idea put into a product. But if you actually accept assets and you're basically trading it, even when a program is doing on a single day, you're still responsible for whatever is happening. And these investors have invested in the product based on certain information provided to them on a relationship you have built with them prior to that. Maybe they're not caring about what you're doing there, because they liked you and know you from different kinds of businesses. So this was a totally different thing, and put a lot of pressure on us on different type of situations, which we did not anticipate when we actually sat down and said, well, the Singularity program, we started to trading it live in July 2010, and it was quite successful. And we said, well, it's successful. It has capacity. We don't see any issues that we run into limitations on the capacity side until much more assets under management. And so why don't we take additional assets from external investors? We had so good experiences with working with external people in the past. Why not do that as well on the actually active asset management side? And so we started the Singularity Fund 1 year later in September 2011, but we haven't really covered all the aspects that would actually change once you start trading external assets.
Can you give me an example of how managing external capital challenged the way you think about what is best from a trading point of view?
In terms of that, you basically have to spend additional time. You cannot just spend time on research and further developing your program, but you have to spend more time on operational aspects as well, and on constant communication. Is that the direction you want to head to with this question?
Yeah, but also in a sense that, sometimes as a trader that this is the best way or this is the right way to trade. But sometimes you have to make commercial, perhaps, decisions where, it could be about, I imagine that some people have a certain risk tolerance themselves, and they know that the program is solid and they trade it like this. And then you start taking external capital and then you find out, well, actually, maybe investors don't have that risk tolerance. And so I can't trade it this way. There are some examples out there in our industry where some firms who have been incredibly successful run with very high volatility. But that's simply because they do know that over time it is the right thing to do. But at the same time, it may be very hard for them to raise assets because not everyone is willing to have that kind of volatility. So it's more the sort of that side of things as well that I thought would be interesting to hear your thoughts about.
Mm-hmm. Probably in the beginning, there wasn't such an issue in terms of this aspect, because we did not sit down and decided to become an asset manager. At the center of our approach used to be and still is the proprietary trading. So basically putting our own assets at risk, and this goes for testing new trading ideas and the development of new trading ideas, as well as the actual trading. And around this, let's call it trader's approach, we have built institutional setup to enable external investors to invest alongside us into our systematic strategies. And this aspect of alongside us was probably one reason why we actually started the external asset management business as well, because we did not see it as the center point of what we're doing, but actually it's something we attach to our prop trading, so to say. Sure. This was a really good idea, and it still drives us the majority of the time. However, once you start taking external assets, you feel much more responsible as well, and you feel new pressures you haven't really experienced before, particularly in times when it's getting difficult, when you have drawdowns. If you lose money and it's your own money, it's your own problem. if it's the team's money, it's a team's problem, and we have to discuss it in the team. For example, if we did if the calculation was wrong, or we had an operational hiccup, the program was down for half an hour or something like that, which fortunately doesn't happen. But particularly in the early days when we started to explore in 2009 and 10, there was still the operational side was not as institutionalized as today.
Sure.
But it didn't really matter so much because we knew that it's our problem. If you're really unlucky and you cannot trade on a particular day, which would have turned into the best trading day of your life or of the year, it's your problem. But once you have external investors' money, it's a totally different game, because they will ask you, why didn't you trade yesterday? We got the broker statements and I can't see any trades, or much less trades than normally. What happened basically? Didn't you miss some of the performance? And this is totally different, because actually, if something like that happens, you can always work on it and explain. Everybody tries his best to have the best operational setup and everything. And we're really lucky that we are working with good service providers, and our setup today is very solid. But before something like that happens, you always feel, you already feel pressure. You're afraid that something like that might happen. Or in a drawdown, you're afraid that the drawdown will actually continue. Whereas as a prop trader, or just trading your own money, you are not as afraid, because you believe in your system. You constantly do reconciliation checks that is the system doing what it's supposed to do, and if it's continuing in a drawdown and you continue to lose money over a certain period of time, and you're happy with it because it's doing what it's supposed to do, that's about it. And you can continue focusing on new research, or just go outside hiking. But if this happens with external assets, you are much deeper in communication with investors. They actually start questioning if what you're doing is actually correct, or if you could actually change it a little bit and it would be much better. If the risk is not too high, things like that. And this is totally different. And I would say overwhelmed the team, particularly in the beginning. We have learned to deal with that. We had our larger drawdown in autumn last year, and learned a lot about that, and did some mistakes back there as well. And I think we are much, much stronger now. And are much more relaxed as well. You can probably argue that as an investor, you have to be careful in selecting your managers in terms of how your portfolio look like, but also with what kind of managers you want to work and invest. And I would argue that exactly the same goes for a manager, that the manager actually has to be very careful about his investors as well. We were very hungry in the beginning and accepted all kinds of different assets. If you want to grow your fund, somebody comes by and says, it sounds really interesting what you're doing, and you have such a great performance, you would probably accept his 100,000, 200,000, 500,000 euros, because it will bring your fund further. But with this particular type of investor, I probably would call it it's fast money, or
Sure.
investors chasing past returns. You have to be really lucky in terms of timing. They're good people, and it's a valid point that you look at investors, at managers, and if they do performance, you want to have a share of it. It's perfectly fine. But as from the manager perspective, you have to be aware that this money will disappear as fast as it just appeared. And you have to be lucky in terms of timing, because if you are at the beginning of a business cycle where the market environment plays into your favors, then it's perfectly fine, because this particular investor will make money. He will see one all-time high after another all-time high. And maybe he will have made enough money once you actually going in a drawdown period, which will happen. Over the entire business cycle, you will have these periods, and maybe he will even stick with you. But if this particular investor is investing in a rough time, or just in a transition period where markets get more and more difficult for you, and you as a manager, that's a certain period, you have to navigate these rough waters, but they most likely will turn into something which is profitable again for you, taken that your models are not broken, or you will not come up with new ideas in case the environment continues in that fashion, then this particular investor will leave you again, and your fund will get smaller again. And this can be really, really tricky, because you're first so happy that you have rising assets, and then you're so disappointed that you're losing it again. And this has been an interesting and important learning, but probably I would not argue that I wouldn't do it again. If you're a young manager and
Sure.
you set up your own business, I would probably still go for the money. But being aware of these different types of investors is a really important thing.
Sure. I mean, the reality is, and I think you make some very important and some great points, Bastian. And at the end of the day, I think it's important to realize that this is the way the journey is. There's no, you don't start out as a new manager and suddenly you get only long-term institutional clients who will never redeem and so on and so forth. You have to take what comes along. And the other thing I think is very important is to just, be open about the fact that, we're not perfect. I mean, and not even the big companies today are perfect. We may not see the flaws, but they're there. I mean, and we're all human beings. We all, take our trousers on in the morning the same way. And so, I think that's very important. I wanted to just, before we jump into sort of the more business and strategy sections, I just wanted to have sort of a fresh perspective from your point of view, because many of the guests that I've had on and been very privileged to have on have 20, 30, 40 years of experience in sort of the hedge fund or managed futures industry. And that obviously gives them a certain perspective as to how they look at the industry. In your case, you're coming from it, still relatively new, but you've actually ventured into this area at a quite important time, just after 2008 and so on and so forth. How does this kind of fresh perspective, without all the back history from the 90s and so on and so forth, how do you look at the industry today and all it's been through in the last couple of years? How do you see it?
That's a good question, because in the beginning, we didn't know much about the industry. As I said earlier, we were not aware that we were actually venturing into the systematic space, or didn't perceive ourselves as actually doing that.
Sure.
Once we actually were in the systematic space and providing a product as well, the Singularity program, we didn't really know how to describe it. So what are we doing here? So what we had to do is actually to reach out to different managers, to go to all kinds of different fairs, listen to all kinds of different presentations in order to get an understanding, how are the big guys in the industry actually talking about their products? How do they perceive the current status of the industry? And of course, we developed an understanding that managed futures programs, particularly trend following programs, were going through a really rough period, that they had strong difficulties in after the post-2008, 2009 environment. But we ourselves, we didn't really face these struggles. Parts of our programs were already trading in the 2008 environment. And of course, the entire program is basically built on data sets, including 2008 as well. And referring to your question regarding the 80s or the 90s, we don't actually look as far in terms of data, in terms of how the program is actually working, because we are only trading futures. So we are dependent on highly liquid electronical markets. And if you look at the liquidity, how liquidity has evolved over time in the majority of futures, you can't really go much beyond the 2000s. Yeah? Actually, for the majority of futures we are trading, the liquidity became sufficient for the way we are trading, I would say, in 2002, 2003, in some cases even 4 and 5. So the equity side, for example, S&P probably earlier, but if you think about grains, for example, or copper, certainly later. So we from this natural setting, what we were doing there, we were not looking much further than what was going on before 2000. But now actually going out and talking to all these different players in the industry, we understood that the industry was going through some kind of crisis and experienced a lot of money outflows. And the interesting thing is, I was just talking about a certain type of investors chasing past returns,
Sure.
And was referring to smaller tickets like 500K or 100K or something like that. But actually, I would argue that the industry experienced that on a much larger scale as well.
Sure.
Managed futures were so successful in the 2008 environment. So basically, when crisis hit the market, they could actually show and play to their strengths. And what happened afterwards? They got a lot of money. A lot of investors, actually institutional and professional investors, which should know better, not necessarily just chasing the returns, actually invested into the space and were quite disappointed over the last couple of years when the space did not deliver. And for us, being a really young and fast developing emerging manager, I would say we observed the entire scene, but we were not as affected by the struggles the majority of players went through. And if you look at our overall development, we were somehow able to make decent amounts of money, so deliver good performance with the program, even that difficult environment, but could not escape the deteriorating effects of a more and more difficult market. So it became even more difficult for us. But I would say we were more like a free spirit in that slightly darkened and sad environment the space was facing over the last couple of years.
Now let's jump to the first topic relating more to sort of your business today. We've heard the story, and as a small manager, we don't need to spend too much time on how you've structured your infrastructure and so on and so forth. But do feel free to share some of that. But what I'm more interested in is actually more sort of the mindset behind the journey. Meaning, as you have to build an organization and have to build a business, how do you decide where to allocate new resources and what to add to your organization first? And how do you balance the risk between adding people too soon before the assets come and adding them too late because people might not invest with you because there's only X number of people? How do you talk? I think a lot of people will really appreciate to understand a real life, real time example of how do you build a successful asset management company from scratch.
Mm-hmm. Probably for us, the starting point, as said earlier, was not necessarily let's sit down and build a business. We already had our trading business going on, and the cornerstone of what we were doing back there was that we were actually doing it being friends. So I sometimes refer to it family style. Yeah? So we did it family style, and we sometimes still say we want to keep it family style, which puts some limits in terms of how many people you want to hire. So if we incorporate new people in the team, there's generally always a thought that can these people stay with us for longer? And we're not necessarily just looking for their talent and their new ideas they're bringing in, but also their personality. And if you can actually imagine spending time with them on a remote island for more than an hour. And considering that work takes a major part of your time, I would say life is way too short to work with people you don't like. So that is one major driver. Or let's say not the driver. It's a cornerstone of the business, or the major pillar of the business. And then you have to, in our case, you have to look at what the Singularity program is actually doing. It's a really fast, highly reactive program. So we have a lot of trading that puts a lot of emphasis on building up a top institutionalized infrastructure once you start accepting external assets, particularly if you want to attract institutional assets. So we were basically forced right from the beginning when we started, we open it up for external investors, that we have to spend a significant amount of resources and time on building up this operational side in terms of having top-tier brokers, in terms of having all these different recovery aspects of business, different server places, doing it in the virtual space, so basically using cloud computing for the servers, but also for the calculations. So this was a major or the important thing we had to focus on right from the beginning, because if you cannot deliver that, particularly when you are trading so much, we will not attract larger assets, particularly institutional assets. So a lot of resources on that. This was kind of up to some part unexpected from the team as well, because it took away some resources we normally would spend on creating new ideas. But fortunately, we started to realize that quite fast, and started to outsource many of the things probably larger investors would do internally. So middle and back office functions, for example, have been outsourced to a top service provider in the industry. So we get the data and we do the reconciliation inside, but they basically gather all the data. Everything has been automated on our side in terms of the actual trading and in terms of how the reporting systems are working. So if you start using very good service providers, you can actually keep it family style. And it takes a while basically to build up these relationships and until everything's running smoothly. But once it is in place, you have so much more time and resources spending on your program. And as we are trading fully automated, we don't have to spend much time and looking after the program in terms of execution. So I would say the major resources went into operations and to continue our research. And this is still the case. We probably see more and more resources on research again, particularly in the last 18 months, because the operational setup is pretty much finalized. We just onboarded another top-tier brokerage relationship in order to be a bit more flexible what we can offer to our external investors. But we're really happy with the service providers we already have on board for a couple of years. So I would say if you're a small manager and you start to think about what can be outsourced, what do I necessarily really have to do in-house, and what kind of resources can I use in order to do my work in-house, then you can actually keep it family style, but grow substantially in assets.
Appreciate that. One question though, and it's probably to deal more with perception than reality, and that is, how do you convince a potential investor that you're able to compete and deliver the same operational excellence than a firm with 50 people do? Because at the end of the day, that's a major challenge, I think, when it comes to attracting these investors, because frankly, a lot of the people who have to make the decision about allocating to a small manager probably feel some pressure in terms of the way they look at their due diligence, and they would feel more comfortable with a bigger firm, even though there may not be any factual difference in terms of operational excellence. How have you gone about convincing people that, you know, it is just as good to go with you than it is to go with a much bigger firm?
It somehow goes back to what I just said earlier, that if you try to build up everything yourself, you're certainly under much more pressure in terms of are they really able to do that and keep the high quality? So you really have to think about what do you want to keep in-house and what can you actually outsource to top-tier service providers. Because the top-tier service provider aspect actually helps investors to tick a box, particularly on the operational side. So all our trading programs are developed in-house. So the trading side, as well as the research side, the backtesting side, this is all in-house developed software. And there basically people, of course, have to trust us that we know what we're doing there, and that we have the resources to keep that up to date and progress over time as well. But in the additional aspects of middle and back office functions, reporting things, these can be outsourced to nowadays. It did not work probably, or the offering was not there probably 10, 15 years ago, because there was no offering to smaller managers because things were way too expensive. But nowadays, even top-tier service providers have offerings for smaller managers, because you don't need the big operational package by one of these top tiers. You can just take part of it, and then you build up over time. If you need an additional reporting function, you can get this additional reporting function. If you need a regulatory reporting function, they can offer it to you. It always takes time to implement these things, but I think that is a really important thing, helping investors to trust you on these aspects of the operational side of the business, and not being afraid that you're small managers in comparison to the larger ones, sure. I would say.
I just had one more question. I was just curious, now that we're talking about sort of the challengings of building something up. What about regulation? I mean, regulation has changed a lot in even since you started, and certainly hasn't made it easier to be small, in my view. What do you think about what's happening from a regulatory point of view, and how does that affect your business?
That's a really, really important aspect of the business nowadays. And you're perfectly right. It changed dramatically. We probably were lucky that we were just fast enough to develop in a less regulated environment, where we could explore into all kinds of different directions, understanding what do we actually want to do, and now are basically well prepared in order to face these changing regulation. If you're a manager and you sit down, or if you actually want to become a manager and you have a trading idea or a program and you want to start your business today, this is definitely more difficult, because for us, having a running business, spending time on developing and understanding what kind of new regulations are actually coming up, for example, thinking about the AIFMD in Europe, or the equivalent in Switzerland, or all these different changes in the US as well, it takes so much time to get an understanding, and you not necessarily have the financial resources in order to actually have external consultants doing all aspects of that for you. So this can actually be overwhelming for somebody starting a new business. And in our case, it has basically resulted to the situation that we are most dominantly focusing on the US as a market, and our entire regulation efforts in further expanding our business currently focus on the US. While we're actually sitting in Switzerland, we do not actively approach Swiss investors or European continental investors. We have all these existing relationships. This is all fine, and there is additional potential for us to grow with these relationships. But in terms of regulatory environment, it has become much more difficult for a new manager, but also for a manager of our size at the moment, because you always have to face the question, do you want to be AIFMD regulated or not? This will take away a lot of time for you, probably for the next 6 or 12 months, if you go down this road, and you need sufficient assets as well in order to pay for the running costs. And I'm not quite sure if that really helps the end investor here in Europe. I understand that people who developed these regulations had probably the best intentions in mind to protect investors. Yeah, that is one of the key reasons, at least what you can read and hear about. It is what is actually happening is basically it's getting really difficult for smaller managers to actually offer their investment ideas to investors out there. And I'm not just talking retail investors. It's even that institutional investors are limited in the options they have when investing based on these new regulations, because they have to tick the box. If they invest into somebody who is not regulated with a certain standard, and something goes wrong, they face career risk. If they are right, nobody will come around and say, well, you did a really good choice. You picked a really good manager, despite him not being regulated to standard A, but just to standard B. So there's a big career risk for decision makers on the institutional side. So they most likely will not take this risk unless they know you really well. And I think that I'm strongly believe that this regulation will probably limit the ability of the European alternative investment space to develop new trading ideas and bring them to the market. Because I would argue that not necessarily just the really big managers come up with new ideas. Of course, they have all these large resources, hundreds of PhDs developing certain things, and they have really interesting products and have been around for such a long time, and I have a lot of respect for what they're doing. But I would say that a lot of interesting ideas are coming from smaller managers as well. Some of them fail, others are successful. And if you take away the opportunity for them to grow because investors provide them with capital, being aware of the risk of providing capital to smaller managers, please, people. Yeah, the investors, not everybody has to be protected. Yeah, but if you have a regulation like that, it forces investors to act in a certain way, and it limits the ability of the space here in Europe to develop. And I think that the US is going in a totally different direction. I think the business environment there becomes more interesting, and there's certain other geographical areas, for example, Asia, where you see a growing community, particularly in our managed future space. So I think this will be difficult for Europe to keep that edge that might have had over the last 10 years.
Sure. No, absolutely. I mean, I think you said it very diplomatically. Another way of saying it is, of course, that it's interesting that many investors are not allowed to invest in a very diversified portfolio of markets with high level of risk controls and so on and so forth. Yet, on the other hand, they're allowed to go out and invest all their money in Enron, and they could, or in any other stock for that matter, which they could lose overnight. So, I mean, regulation certainly is an interesting factor in all of this. But anyway, let's shift gear and talk about something which is, I think, really important when you look at any manager. And that's the track record of a strategy, because as we know, many strategies start out in one way, they build a long track record, but over time it evolves. And therefore, it can be very difficult for any investor to look at a track record and get a meaningful idea of what performance risk might actually look like going forward. And of course, we know that we always have to say past performance is not indicative of future results, which is very true. But looking at your track record, how would you say people should read it? Are there any things along the way since 2010 when you started where you said, yeah, this was kind of one period of what we did, we then evolved a little bit into this? And how would you advise people to read your track record when they look at it?
Mm-hmm. Particularly when referring to the chasing past return aspect, what we discussed earlier. I think there are two dimensions. The first dimension is, has the manager done something differently over time? Has the program evolved into a certain direction? And the second dimension is, have the markets evolved? Has the market environment be the same the entire time? Because, of course, the results are dependent on a market environment as well. And if you want to look at both dimensions, you have to take a lot of time, particularly when sitting down with a manager to get an understanding. So what are you actually doing? How does this result? What kind of results do I expect in a certain market environment? Then actually refer back, okay, 2010 was such a market environment, 2011, 2012, 2013, this has changed. This is one aspect why your P&L went up or down in certain periods. And at the same time, they have to cross-check, have you done anything differently? And I would argue that the managed future space, if you work on the systematic side, you constantly work on the research side to cross-check if your earlier assumptions are correct, if you have done something wrong, if everything's working in line. And you should not only do that if you are in a drawdown, but you should constantly check. Also, when you have higher than expected returns, you better make sure that you understand why this actually has happened. And at the same time, you basically come up with new ideas. And you want to introduce these new ideas to the trading program, but make sure that it does not result in what people refer to as style drift. Because If you have investors just chasing returns, they are fine if you have returns. But as a manager, you would like to head, I would say, more in the direction that investors have you in their portfolio because you deliver a certain risk-return profile. And these investors are really exciting ones because you can have really deep discussions with them, and they stick with you as well when you have a drawdown. And you can learn a lot from these discussions as well. So from our case, we are most interested in these kind of investors. I would probably call the institutional, professional investors who put together portfolios with you being a building block of their portfolio, in the expectation that you deliver something and you don't have any style drift there. And so you have to make sure if you come up with new ideas that these new ideas are well thought through, tested from all kinds of different angles in order to reduce or mitigate the risk that they basically change your risk return profile. But at the same time, you have changing market environments, which could make this picture a bit blurry. So you might think that you're still doing the same, but you're not, because the market environment changed and it just looks the same, or exactly the opposite. You are doing the same, but the results tell you you're currently not, but it's driven by the market environment and not by the new ideas you actually have. So that's a thin line you have to walk as being a manager by further evolving your program or developing new ideas. And this is something which takes a lot of time when sitting down with an investor, because they have to have the patience and particularly the interest to develop the understanding in what kind of market environments you actually expected to deliver what kind of performance. And if you look at what basically happened in the Singularity program, the core of our program has remained the same since July 2010. So the idea how Singularity looks at incoming price data and analyzes this price data and generates signals has remained the same. And our strong focus just on trend following signals, despite not being a trend follower, but we probably will go into that direction a little bit later in our communication, has remained the same. But and we have an aspect where we say, if something is not automated, you should automate it over time. So whenever you have a manual process in a systematic way, but manual, you should try to automate it to exclude human error, and at the same time to have the potential of increasing complexity to look at a higher number of variations a human being might not be able to cover in that manual process. And there have been two things where we basically automated aspects in our trading program. In 2011, we automated our allocation process, basically from a manual process by our portfolio manager in 2010 to an automated process where the program is putting together the portfolio based on the same rules the portfolio manager did it in the past. But this also allowed us an increasing complexity in terms of how you can actually put together the portfolio. And a second thing I would argue is the allocation process in terms of markets. What kind of markets do you actually have in your portfolio? And this has been something we had on our research list for quite some time as well, and which has been introduced in 2014, where now basically the number of markets being in your portfolio on a monthly basis can be higher or lower depending on certain drivers, market conditions, and particular volatility in certain markets. So this has been something which was a manual process, so to say, in the past, and has been automated. But yeah, that's probably it in terms of how the program evolved.
Now, we're going to jump into the nitty-gritty of the program, of course. And I want to just make the audience, I just want to make a couple of observations, because this is where I think it's really interesting, and I very much look forward to your explanation. But I think one way of looking at what you do is to try and make the distinction between the fact that many managers, when we research certain things, we put together a model that has certain parameters, and we tend to run that model over a number of markets, and these things are constant. But what you're doing is very different. In a sense, you're trying to set the team, both in terms of models and systems, parameters, markets, every single month. So take us all the way from the top and all the way down and explain what the Singularity program really does and what it's all about.
Mm-hmm. So basically, today we have the Singularity program, which is a futures trading program. And we have a second program we call Singularity Pure Equity, which is basically taking the Singularity trading philosophy and just employing it to the equity markets. These are basically our two programs, but they have the same original thought, how we look at markets and how we're trading the markets. And Singularity is purely systematic and fully automated. So, and it trades only futures across liquid future markets, currently up to 23 markets across all asset classes. So that is basically a starting point when you want to categorize it, so to say. And we have designed it to deliver, we call it a multi-directional alpha stream. So basically independently from the direction of whatever market, trying to capture different return sources or return drivers and generating an alpha in comparison to traditional approaches, particularly in the alternative investment space, and consequently showing a low correlation. And we do that by employing a quantitative analysis of real-time price data. So the interesting part is that while I said it earlier, we only employ trend following strategies, we actually do not show any correlation to the trend following space. And this was a very difficult aspect for us as well when developing a better understanding what we were actually doing when communicating to the investors. Because as we did not sit down and develop a systematic program, in particular, nobody in our team basically came from academia in terms of systematic trading, or used to work for a different systematic asset manager. We haven't had the terminology in order to describe what we were doing. And as we were only trading trend following signals, we went out to investors and say, well, we have a trend following program. But we made money when they didn't make money, and we lost money when they made money. So no correlation. So we had to learn over the time by communicating with investors that while actually using trend following signals, we probably are not a classical trend follower, particularly in the way we're trading. And we nowadays strongly believe that this idiosyncratic profile is driven by what we refer to as intra-market diversification, which is probably a term just used by us. And we came up with this term by going out to investors. And one day, for example, in the really early days, we were trading 8 markets at the time. Our performance was quite good. And we sat down and said, well, we have a trend following program. We currently trade 8 markets. And the guy stopped us immediately and said, wait a moment, you're only trading 8 markets. You're not diversified. How can you only trade 8 markets? Yeah? And this was a big question. Why are we not diversified? He said, go back home and do your homework, something like that. So we went back home and we said, well, okay, let's do our homework. First, we only use trend following program signals. We deliver performance here, but he said we should do our homework. So why are we not diversified? What means diversification? So we looked at different programs, and I would argue that a classical trend following program has a smaller number of well-researched and robust strategies or models, and they employ it across a large number of markets, as large as possible, 50, 80, 100 markets. Some people actually tell you that they're even trading more markets. And that's probably the aspect this particular investor was referring to when he actually gave us homework. And we said, well, but we are trading 8 markets and we actually do not feel that we are not diversified in terms of, if you look at our risk and how everything's evolving, we have quite some diversification here. And then we realized that diversifying across a high number of markets is probably something we could refer to as cross-market diversification, which is certainly an important thing and has been around for a really long time in investment. Everybody knows that if you diversify across different asset classes and different markets, there is something in there. And so we looked at it, so what are we actually doing? And we employ a really high number of strategies or strategy variations in every single market we are trading. So when we went to this investor and said we're trading 8 markets, what we missed to tell him is that we are trading 8 markets, but we have around 1,000 different variations of strategies being active in these markets while we're actually speaking. So we came up with this terminology, what we refer to as a strategy element, because these are actually not thousands of strategies, but they are variations of strategies. And if you look at Singularity nowadays, if you have, for example, a portfolio of 10 million, you would probably expect 1,500 strategy elements in something in up to 8 till 12 markets, maybe 14 markets. That actually means that every single market trades, let's take 10, that makes calculation easier.
Sure.
Has 150 strategy elements. So what does it actually mean? So we have to look at it. What is a strategy element? And this is a term we came up because I said earlier that we developed our trading software and testing software all in-house. And if you're a programmer, you have these objects which are hard-coded and defined. And a strategy element is an object in the programming language, where we define certain rules, and we actually define it on 3 different levels. And then you take this object and put it into the trading program and let it trade for the entire month.
Okay, so I'm gonna stop you there and just try and explain that again with using sort of a terminology also that everybody understands. Let's make it really basic here, in terms of what variations could that be?
Mm-hmm, sure. So you have a strategy element, and it has 3 layers. On the first layer, we define what kind of trend following strategy this little fellow is using. So you can think about it as individuals, actually.
Yeah.
Thousands of individuals with different characteristica, and they look differently at markets. So first level, trend following. Let's take moving average.
Right.
And the second level is what we refer to as trading parameters. So one trading parameter could be, for example, time. So it's 150 days average. And then the third level, you have risk parameters, a stop loss, and you can calculate stop loss in different ways. So this little fellow gets a certain type of stop loss, or take profit is another thing. So he does take profit based on certain rules. And this is hard-coded. So this little guy will always follow his rules based on these 3 layers.
Exactly.
And let's say this is the little guy number 50. And now we have his friend number 51. He is also using a moving average. But he doesn't have 150 days. He has 160 days, but the same stop. Mm-hmm. And then you have number 53, 54, 55. So you have a high number of variations once you start slightly changing or giving different values to the 3 different layers.
Yes.
So potentially you can create a universe of thousands of combinations of strategy elements. And that's basically what we are doing when we are defining the potentially tradable universe on a monthly basis.
Mm-hmm. Yeah.
And then you have a process where you basically systematically select these strategy elements across a given number of markets. It's a process which slowly builds up the portfolio, framed by strong risk criteria. And in the end, you have these 1,500 strategy elements, for example, for an account of 10 million. And then these elements trade independently for an entire month. And this is a really interesting and important aspect. For example, let's take 2 little fellows in gold. And gold is trading, something is happening on the market, and one strategy element gets a signal to go long. So it buys 1 gold contract. And actually, another gold strategy element 2 minutes later gets a signal to go short, because it's based on different rules, based on these 3 different layers. So it's a different entry point for both of them. Yeah. So there are 2 different entry points, and we let them trade freely. So the portfolio is, of course, always a net result of all the positions and actions of these strategy elements. And this results in a high reactivity because they all trade independently. They don't look right and left what all the other guys are doing. And you do that for an entire month. And that's why we argue that there is an intra-market diversification, because these strategy elements, even when being employed in the same market, they try to capture different drivers of return. and they do not depend on the actions of the others. They all do it independently. And some of them are successful in that particular month, and some of them are not successful. And your trading result is basically a result of all these independent actions of these strategy elements.
Why did you choose 1 month? Why not 2 months or 3 months? Why does the team need to be reset every month?
It's a really good question, because 1 month is not a natural, it's a given point. In fact, of course, once you develop something, we as a team always argue you have to make sure that you mitigate the risk of curve fitting. So if 1 month is just the best you can do based on the data set you're developing it, that's a really dangerous thing to do. So you basically should test if it also works with 3 weeks or 5 weeks or even much longer periods. And we realized when testing it that it's the reality is probably somewhere between 3 and 6 weeks. That's all fine, and it doesn't have to be 1 month. But if you come from an asset manager perspective and you're dealing with outside investors, generally you have incoming assets and outflowing assets on a monthly basis. So it naturally makes sense to allocate the portfolio on a monthly basis if it's not putting you in a much worse position in comparison to, let's say, 5 or 6 weeks. So when we tested that, we basically got what we refer to as a plateau result. 4 weeks was pretty much good as 3 weeks or 5 or 6 weeks. So we could be sure that we haven't just pinpointed and we're lucky and just found exactly the right spot for the data we developed the system on, but it's actually quite robust and stable because we are sitting on a plateau when actually doing it on a monthly basis. That's the reason.
Sure. So you have all these different strategy elements in your portfolio that you can choose from, and we need to talk about how the selection process takes place, I guess, as well. But tell me, before we go down that path, tell me a little bit about these small fellows, these strategy elements. What do they look like? What kind of strategies? Because trend following, are many things to many people. You mentioned moving averages, maybe there's some other things, but also I'm thinking in terms of time. How short is the shortest fellow and how long is the longest fellow, if we keep it that way?
Yeah, that's. We sometimes refer to them really as fellows because
Sure.
This makes things. I like the graphic aspects of it.
Sure.
They all use trend following. So you're perfectly right. You said there's more than moving averages. We have range breakout as well, which probably is important. We did not come up with a new idea or concept how to look at trend following or what
Sure.
trend following actually means. We were actually not even bothered to be a trend follower. We said we like these basic strategies, and they have been well researched, and so we don't have to put much time on that, and we can actually focus on how to actually define these fellows based on level 2 and 3. And the idea was basically to have a real high number of variations. It's probably where our proprietary trading on the discretionary side comes into play, where we have all kinds of different ideas what can actually happen on the market and how how these fellows actually could and should react to it, but not in order to just pick the ones you think which are the best. You actually offer the entire process a high number of variations. You create a large, potentially tradable universe of strategy elements, and at the same time you spend a little bit more thought on how they're actually selected. Yeah, that's probably an additional very important part.
Sure.
If you think about optimization, particularly over-optimization as well. So yeah, probably it makes sense to look at the allocation process.
Sure.
At this point, which is a two-step process in our case, where the universe is first defined in terms of which markets are actually potentially ready to trade for this particular month.
Sure.
And in the second step, all strategy elements in all these markets be ready for trading for that particular month are basically competing for a spot to be picked. It reminds me sometimes of the movie Shrek, where Donkey is jumping, he says, pick me, and that's it's a little bit like that. Yeah,
I think that's a good visual description. Yeah.
In the early days, basically what happened, if you take a strategy element, you can calculate the profitability of this strategy element based on what is called a forward walk optimization process. Mm-hmm. Yeah, and you basically can create heat maps. It gets really tricky when you have a higher number of parameters with even higher number of variations for these parameters, because then the potential tradable universe becomes really multidimensional, and it's not possible for a human being to get an understanding where profitability lies in that particular universe and where are areas which are not as profitable. But in the early days, when this process was not automated, the portfolio manager sat down and actually systematically selected strategy elements based on different criteria, among others the profitability. And if you do it in a colored heat map, profitability is green, dark green, highly profitable, and red, highly loss-making for that particular period you're looking at. And then you build up the portfolio. And the portfolio manager naturally, as a human being, say, well, let's take the green ones. They are highly profitable, though. This is a really good choice. And fortunately, he somehow got it right. This is referring also to 2010. Sure. But fortunately, in 2011, as said earlier, we introduced the automated selection process. Sure. And then we realized quite fast that actually, if you do it in an automated, computerized way, the allocation process actually picks a lot of red ones as well, because red ones are maybe not profitable over that particular time window, but they're diversifying. And as an important aspect, I said earlier, the entire allocation process is framed by really strict risk criteria. In our case, there are several risk criteria. One of them, probably the most dominant one, is downside volatility. So the portfolio is built up by selecting these little strategy elements step by step, putting together a portfolio, but it's constantly checking that the combination of strategy elements it's selecting is meeting the risk criteria. So it does not, there's no incident in the past based on the data set you're using, which has caused a downside volatility in excess of 10%. In a 1x version. Sure. And if there's something highly profitable combination, but it does not meet this risk criteria, it cannot be part of the portfolio. So the little guy can jump as high as he wants and says, pick me. If he might be highly profitable, but if he, in combination with the others already being picked, is causing a risk incident, he will not be picked. It's really sad thing for him, because he himself is really profitable, so he will probably not understand why not being picked. But the allocation process is framed by these risk criteria, and it cannot be guided by just profitability. Sure.
I'm glad it's all done sort of from an electronic point of view. Otherwise, there would be a lot of disappointed fellows in your office every month.
That's correct. If they stand in line waiting to be picked, that would be a really sad picture, because the majority of them are actually not picked. So they all have to go back home. One has to say they have a new chance next month. Sure. This goes for the strategy elements, and this also goes, I said earlier, it's a two-step process. In the first step, markets are selected. I just the other day I explained it to an investor how the market selection process is actually working, and I said, well, imagine all markets. We currently have 23 potentially tradable markets, and maybe a short detour here.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.